Hi, I'm John Mark Young. Welcome to our Question of the Week video. And this week's question comes from Jayson in Panama City, Florida. And he asks, you guys spend so much time and focus on interest rates. Help me understand the rippling effects of these changes and why they're so important to us as a consumer. So basically, what happens when the Fed lowers interest rates? Because yes, Jayson, we have been talking about that. So let's talk a little bit about what happens. Now, when the Fed or the Federal Reserve lowers interest rates, it typically aims to stimulate lowering rates. They're trying to stimulate the economy by making borrowing cheaper, not something we would advocate for as Ramsey followers. This can lead to several outcomes for the U.S. economy and the stock market, and ultimately your wallet. So let's talk about those. Point number one, provides economic growth. Consumer spending is increased with lowering interest rates that reduces the cost of borrowing, encouraging consumers like you and I to take out loans for big purchases like homes, cars, thus increasing consumer spending. It also increases business investment. So think about your company. If you own a company or the company you work for, they might increase investments in new projects due to the lower cost of financing, potentially leading to job creation and economic expansion. So this is why we say watch out for small and mid-cap stocks when rates get lowered. How about the stock market reaction? That's going to get reacted by lowering interest rates. There's going to be a short-term boost typically because the stock market may react positively to interest rate cuts as investors anticipate higher corporate profits from increased spending and increased investments that they're making like we talked about earlier. However, the longer-term impact is going to be less certain than the short-term impact. While lower rates can support higher valuations, they also reflect concerns about economic slowdowns. If the underlying economic conditions are weak, any gains that we get on the short term might be temporary. So you just don't know about the long-term effects, although the economy, as long as it's growing, long-term should be good. How about what lowering interest rates can mean to inflation? Because that's another thing that's going to happen. Well, the goal is a moderate increase of inflation is often the goal of lowering interest rates. So that might sound counterintuitive why we're talking about interest rates right now, because we're still actually trying to get interest rates lower. But it indicates that we have rising demand for things. And if inflation rises too quickly, it of course can erode purchasing power. We saw that all last year. So the goal is as they lower interest rates, they actually want inflation to come up a little bit, but not too much. Okay? And there's a limit to how much the Fed can actually cut interest rates, of course. If rates reach zero, we're kind of done. We've never gone into a negative interest rate territory like some countries have. The Fed might resort at that point to measures like quantitative easing to stimulate the economy. We've definitely seen that happen, QE 1, 2, and 3. And finally, what actually happens to asset prices when interest rates are lowered? We talked about stocks earlier. So typically real estate can, with lower rates, that's going to increase demand for real estate, driving up property prices. That's why one of our themes this year is lower mortgage rates, buoy to the real estate market, buoy to the overall economy. How about bonds? Well, when interest rates go down, bond yields typically fall, the interest rate you're getting on your bonds, and that can increase the prices of bonds in the short term. They're still going to mature at par value, but the prices can go up, allowing you to maybe trade some bonds. Savings and retirement accounts, what about those when you get lower yields? Well, your savings account and other fixed type of interest investments, they're going to probably start generating lower returns, prompting investors to seek higher yields elsewhere. The TINA play, there is no alternative when rates were zero. So this is where you want to talk to your financial advisor about, how do you adjust your portfolio or your savings account to meet your strategic goals. Ultimately, we never tell anyone, Jayson, to put your emergency fund in a at-risk investment, or at least a high-risk investment, because the goal of the emergency fund is to provide that protection. Ultimately, what the Fed is trying to do, and why we talk about interest rate decreases so much, Jayson, is because as interest rates go up, what the Fed is trying to do is stimulate the economy to the upside. Now, we've constantly talked this year about this soft landing, which is to say, well, the reality is the labor markets look great right now. There's no issue there. Everything else seems to be playing out pretty good. So why would the Fed start to lower rates in an environment like this where everything seems to be okay and we're bringing inflation down there? Do they truly want to stimulate the economy anymore? And this is why many people say maybe we don't get an interest rate decrease in 2024. That remains to be seen. At this point, Jayson, the best odds-on favorite are that we're going to be looking at a possible interest rate decrease at the June FOMC meeting, and Friday's PCE number definitely helped that argument. But it all remains to be seen. And if we start lowering interest rates, which will start stimulating the economy, the real estate market, and all those other things as we talked about, does that push us back into the inflation game? Remains to be seen. But the stock market definitely, as we talked about, short term, loves those lower interest rates. So we'll keep riding that wave. Thanks so much for asking that question, Jayson. And if you have a question you'd like to ask us on the Question of the Week video series, put it in the comment below. We'll take a look at it. You can email your financial advisor, and they'll get it over to us. We'll be happy to answer any of those questions that you have. As well, if you'd like to schedule a meeting with any of our financial advisors, go to the comment section of this video. In the comment section, you'll see a link where you can click on, and you can schedule a meeting with any of our financial advisors or coaches. Our coaches help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, live on a budget, and hold you accountable to that budget. And our financial advisors and planners will help you in baby steps 4, 5, 6, and 7 so that you can build out a retirement savings plan, save your kids' college, get that house paid off earlier so interest rates don't even matter to you anymore as it relates to the debt side. And you can get to baby step 7 where we get to live and give like no one else. Thanks so much for watching this video. We'll see you next week.